Hi, I'm Pattu from freefincal and welcome to another edition of Mutual Fund FAQ, where we discuss some of the basic questions that investors have on mutual funds. This time let's consider what is the benefit of a debt mutual fund. Now, I had made two videos before, one describing what is the debt mutual fund and another asking whether you need to invest in mutual funds and if mutual funds have any benefits in general. And in the first video, I described what is a debt mutual fund. You can start from there. And in the second video, I had said among one of the top benefits of investing in mutual funds, the ability to invest in a variety of bonds that a debt mutual fund offers in its portfolio is one of the key benefit. And in my book, I think it's the topmost benefit of investing in a mutual fund. So let's consider that in detail in this video and ask what is the benefit of investing in a debt mutual fund. Now, a debt mutual fund can invest in bonds that mature overnight. That is, you give the money to the bond issuer today, and tomorrow morning they will give it back to you with a little bit extra. So that's an overnight bond. And it can also invest in bonds that will mature in 30 or 40 years. So from overnight to decades. So that's a huge span in tenure. So a mutual fund, the debt mutual fund, can invest in pretty much any tenure, and it can invest in bonds issued by the government. It can invest in bonds issued by public sector undertakings, by banks, corporate deposits, for example, corporate fixed deposits or certificate of deposits, certificate of deposits issued by banks, or they can invest in corporate fixed deposits. Just like they are available separately as a corporate FD. You can also have a corporate bond issued by businesses. So it can invest in a wide variety of bonds. It can do hedging with bonds, so it can take arbitrage positions with bonds, and it can do something called interest rate swaps. That I'll talk about that in another video separately. So these are things that a retail investor cannot do. For many bonds, the ticket size would be quite high, and so a retail investor cannot take exposure to such bonds individually. And even if they are capable of doing that, they will be taking on too much concentration risk. That is, they'll be putting all their eggs in one basket if they do that. And in a debt mutual fund, that concentration risk is naturally gone. The maximum exposure a debt mutual fund can have in a single bond is only 10%, and often it is much less. So the debt mutual fund portfolio will be usually well diversified, and that's not possible for a retail investor to do. So that's the key benefit, one of the key benefits in investing in a debt mutual fund. Now, the other benefit is taxation. Now, if you buy an FD, if you buy a corporate deposit, you have to pay tax as per as per slab, the tax on the interest as per slab. But in a debt mutual fund, you have to pay tax only when you sell, and any unit, the gain associated with any unit within 3 years, it's taxed as per slab, and above that it is taxed at 20% with indexation of the purchase price. I have described this in another video on how the mutual funds are taxed, and debt mutual funds belong to the non-equity fund class. So you can look at that in detail. Now, this is a great benefit, especially for people in the 30% and 20% slabs. They'll be paying much less tax, and even for less than 3 years, if you don't redeem the full amount, and if you redeem in chunks, if you take a little bit 1 year and a little bit another year and so on, the effective tax that you will be paying will be lower than your tax slab. This is not possible in a fixed deposit. In a fixed deposit or a bond, it's single unit. You cannot sell half a bond. You cannot sell half a fixed deposit. You have to break the deposit and take the money. This is the beauty of a debt mutual fund. You can buy 100 units and sell 5 units after 1 year, 2 years, whatever, and another 25 units sometime later, and so on. So you can sell at will, and that's a fantastic benefit. This is the big difference. See, when it comes to equity mutual funds, In my opinion, the two biggest benefits are diversified portfolio with little concentration risk, little or no concentration risk, and ability to track an index. I've mentioned this in another video. But if you don't like that, if you think no, these fund managers, they're anyway buying the same stocks, why do that on my own and so on, that kind of arguments are there. So if you think investing in an equity mutual fund is a waste of time, that's fine. Go buy stocks on your own. That's quite fine. As long as you have the money to buy a single stock, you can buy any stock, right? So that's not a problem. So, but in a debt mutual fund, the ball game is completely different. See, if you buy a corporate deposits, for example, a BB rated deposit or a B rated deposit, something that offers you 10%, 11%, 12% interest rate, that's a huge risk to buy. You putting money in a single issuer with that kind of risk. Just because the interest rate is high, people think it's okay to buy that. The reason why the interest rate is high is because the credibility of the issuer is the bond issuer, suspect. And if you do that, everything will look okay as long as the interest is coming regularly. If there's one default or a delay in interest rate payment, then everything, then there's chaos. Then there'll be a run. All the depositors will come and ask the money, and the issuer will abscond or whatever. They'll say they'll declare bankruptcy or whatever. It'll be chaos. In a debt mutual fund, that can happen, and that will happen, and that has happened. But as long as the concentration in a particular bond is low, it will only fall by 2-3%. And if you choose your debt mutual fund carefully, you can avoid that as well. And that is why I love debt mutual funds, and I think they are the best product in the mutual fund space, in my opinion. They're better than equity mutual funds any day, because they have so many unique features. Just that you should understand how to choose a debt mutual fund by understanding the associated risks. So we'll cover that in a separate video. Bye bye.